Now speaking, Tim Power, Vice President, Investor Relations. Good morning, everyone. Thank you for joining us for our second quarter 2023 earnings call. Today, we have Giovanni Caforio, our CEO, and David Elkins, our CFO, who will be providing prepared remarks. We have also posted slides on bms.com for your reference. Before we begin, I want to highlight that our forward-looking statements may differ from actual results due to various factors, as discussed in our SEC filings. We will be focusing on our non-GAAP financial measures, which exclude certain specified items. Reconciliations of these measures to GAAP measures are available on our website. Now, I'll turn it over to Giovanni. Now speaking, Giovanni Caforio, Chairman and Chief Executive Officer. Today, we updated our outlook for 2023, with a significant change in expectations for Revlimid and Pomalyst. However, our in-line and new product portfolios remain strong, and we are confident in doubling revenue from new products this year. We are reaffirming all our financial commitments for the 2020 to 2025 period. We also announced our intention to execute a $4 billion accelerated share repurchase in Q3. The decrease in Revlimid and Pomalyst revenue is due to an increase in utilization of free drug provided by the independent BMS Patient Assistance Foundation. This issue is the main driver of our revised guidance, but we do not expect these dynamics to continue into next year. The impact for Revlimid and Pomalyst will be approximately $1 billion and $300 million, respectively, for the full year. Our new product portfolio continues to deliver strong growth, and we expect to generate $10 billion to $13 billion in revenue from this portfolio in 2025. We have also achieved important clinical milestones and presented strong data for our pipeline assets. With 60% of revenue erosion behind us, we are on track to meet our commitment of growing revenue low to mid-single-digit CAGR from 2020 to 2025. Our focus and confidence in portfolio renewal are strong, and we have 4 important levers to drive our performance beyond 2025. We are executing well and excited about the future of Bristol Myers Squibb. Now speaking, David Elkins, Chief Financial Officer. Total company sales in Q2 were $11.2 billion, driven by the strength of our in-line and new product portfolio. Our new product portfolio grew 79% in the quarter, generating $862 million in sales. Opdivo sales grew 11% globally, driven by demand for newly launched and core indications. Opdualag had a strong launch in first-line melanoma, with market share approaching 25%. Eliquis generated sales of approximately $3.2 billion, driven by demand in the U.S. Reblozyl had a strong quarter with revenues of $234 million, growing 35% driven by demand. Abecma and Breyanzi had robust sales of $232 million, growing 81% and $100 million, doubling versus prior year, respectively. Zeposia sales grew 52% globally, driven by demand in multiple sclerosis. Sonic-2 had a successful launch, with over 23,000 script equivalents and a market share approaching 40%. Our updated 2023 guidance reflects the decline of Revlimid and Pomalyst revenues, with expected low single-digit decline in revenues and operating expenses. We expect our new product portfolio to roughly double versus prior year. In 2025, over 90% of our business is expected to come from our in-line and new product portfolios. Goldman Sachs analyst Chris Shibutani inquired, when do you expect to see the inflection point that will build confidence in achieving the $4 billion revenue target for Camzyos, considering the challenges in developing a new market and the various factors involved? Chris Borner replied, "Thank you, Chris. We are indeed very confident in the progress of our new product portfolio. Our goal of doubling the revenue to $10 billion to $13 billion by 2025 remains on track. We have made significant progress across the entire portfolio, including Camzyos." Adam will now provide more specific details on Camzyos. Adam Lenkowsky replied, "We are pleased with the performance of Camzyos, which is meeting our launch expectations. We are seeing steady and consistent growth in patients treated with Camzyos, similar to a product like Eliquis. Year to date, we have momentum in both patients coming into the hub and commercial patients. Patient and physician feedback remains positive. The Valor approval in Europe further strengthen Camzyos' profile and will drive adoption. We are confident in continued and sustained growth in 2023 and beyond." BMO Capital Markets analyst Evan Seigerman inquired, "Can you provide more insight into the rationale behind the accelerated share repurchase, considering the potential need to reinvest in the business to drive revenue growth in the near term, particularly in light of the Revlimid situation?" Giovanni Caforio replied, "The decision to execute the $4 billion ASR is driven by our confidence in the future of the company and our strong financial position. We are investing in our pipeline and committed to business development as a central pillar of our capital allocation strategy. Our capital allocation strategy remains balanced, and we made the decision to execute the ASR in Q3 based on our confidence in the company's future. Bank of America Merrill Lynch analyst Jeff Meacham inquired, can you discuss the risk of recurrence of copay assistance for Revlimid and Pomalyst until 2024? Additionally, how should we consider the demand and market share for Sotyktu with CVS and other payers removing step edit in the second half of this year and going into 2024? Giovanni Caforio replied, we anticipate that the challenges we have experienced with Revlimid and Pomalyst will be temporary and limited to this year. Our confidence is based on two key factors. Firstly, we have observed a return to normal levels of 3 drug applications to the BMS Patient Assistance Foundations. Secondly, there are significant changes to the Part D design next year that will enhance patient affordability. These changes include the elimination of patient contributions to the catastrophic phase and an expansion of the patient pool that qualifies for lease. As a result, we expect the impact on Revlimid and Pomalyst to be primarily limited to this year. Adam Lenkowski replied, we are pleased with the Sotyktu launch, with our market share nearing 40% of the oral new demand market. We have seen significant progress, doubling the volume of TRX equivalents from Q2 to Q1, with over 23,000 prescriptions since launch. The recent access win with CVS, covering approximately 30 million lives, is a significant milestone. We anticipate a ramp-up in the commercial product in the latter part of the year, as we continue negotiations with payers for improved access in January. Overall, we are confident in our launch performance, execution, and growth prospects for the second half of the year and beyond. Morgan Stanley analyst Terrence Flynn inquired, can you discuss your confidence in Reblozyl securing a broad label in first-line MDS? And is there any update on the Opdivo Hodgkin's lymphoma indication in the frontline setting for NCCN guideline updates? Sumit Hirawat replied, thank you for the question. The Reblozyl study was conducted using intent-to-treat principles, comparing it to ESA for RS-positive and RS-negative patients. The data showed efficacy in all patient populations, with a consistent benefit in reducing transfusions and offering long-term contributions. While we cannot comment on the label and regulatory discussions, we are confident in our data and look forward to sharing more when the label is finalized. Adam, anything to add? Adam Lenkowski replied, we are seeing strong growth for Reblozyl both in the US and internationally, driven by the COMMANDS approval. The upcoming PDUFA in 4 weeks is a significant milestone, and our US team is fully prepared for the launch. Physicians have expressed a strong interest in using Reblozyl due to its durability and potential for transfusion dependence. This positions us well to become the new standard of care in the first-line setting. Regarding Opdivo and CHL, we are pleased with the data presented at ASCO, which showed superiority over in a head-to-head study. Oncologists have indicated that this data is practice-changing. It is important to note that this study confirms our current indication under accelerated approval. We will collaborate with on analyzing the full data set and engage with regulators to discuss the findings. We also anticipate the inclusion of Opdivo as an option in the NCCN guidelines in the coming weeks to months. JP Morgan Chase & Company analyst Chris Schott inquired, just to clarify, has anything else changed in your revenue outlook besides the updates for Revlimid and Pomalyst? And regarding Breyanzi and Abecma, when can we expect the next increase in capacity for these products and what kind of ramp-up can we anticipate by 2024? David Elkins replied, yes, that's correct. The only adjustment we made to our guidance was in relation to our Revlimid and Pomalyst products. Adam Lenkowski replied, we have made significant strides in expanding our cell therapy franchise. Our focus is on rapidly increasing our presence in both the US and international markets by expanding our supply. In terms of CAR-T manufacturing, there are 2 key components, drug product and vector. We have successfully ramped up capacity at our existing sites for Breyanzi and Abecma, with additional ramps planned for later this year. We are also constructing new state-of-the-art facilities in Devon, Massachusetts, and Leiden in the Netherlands, which will further enhance our capacity by 2025. In terms of vector, we are both internalizing and externalizing production to expedite capacity expansion. Our new vector manufacturing plant in Libertyville, Illinois, is part of our dual sourcing strategy, complementing our partnerships with third-party manufacturers. Additionally, we are accelerating our transition to next-gen vector technologies. Overall, we are making excellent progress and increasing capacity for both Abecma and Breyanzi. Giovanni Caforio replied, our manufacturing investments are a key part of our broader strategy, which is crucial for the growth of our platform. We have an exciting portfolio of cell therapy assets, including GPRC5D and NextTCD19, which will greatly benefit from these investments. Stay tuned for more updates on our R&D Day in September. Guggenheim Partners analyst Seamus Fernandez inquired, first, could you provide an update on the development pace and market opportunity for the LPA1 program in IPF and PPF? Additionally, I would like to hear your thoughts on the potential for a preliminary injunction due to pressure points around the Fifth Amendment in relation to the IRA. Furthermore, could you discuss any positive influences of the IRA in 2024 and 2025 that could impact your revenue lines? Giovanni Caforio replied, "While I cannot comment on the litigation or speculate on its outcome, I want to emphasize our concerns regarding IRA's potential negative impact on innovation in cancer care. We also have reservations about the price-setting process. However, there are positive aspects to IRA, such as improved affordability for patients. For instance, next year, patients will no longer contribute to the catastrophic phase, and there is an expanded definition for lease eligibility. These changes align with our commitment to patient centricity and have a positive impact on our business, including Eliquis." Sumit and Adam will now address your question on LPA1. Sumit Hirawat replied, "Thank you for the question, Seamus. Both IPF and PPF are conditions with a high unmet medical need. Currently, there are only 2 approved treatments for IPF and 1 for PPF, but they have limitations in terms of safety and duration of treatment. Our LPA1 inhibitor has shown efficacy in improving outcomes for these patients, as demonstrated in 3 different studies. We have seen improvements in FVC reduction in both IPF patients without background therapy and those on background therapy. We will also be sharing data on EPF later this year. Based on these positive results, we are confident in launching Phase 3 trials for IPF and PPF in the near future." Adam Lenkowski replied, "We are very encouraged by the potential of our LPA1 asset in addressing the high unmet need in IPF and PPF. The prognosis for these diseases is similar to some metastatic cancer diagnoses. Our efficacy and safety data have been very promising, with no GI or liver toxicity observed in the early phase. This gives us confidence to move into Phase 3. Current treatments have limitations in efficacy and toxicity. Improving awareness and diagnosis tools will help increase the low diagnosis rates, which currently range around 30% to 40%. We believe that when we bring our LPA1 to market, we will significantly accelerate diagnosis rates and make a meaningful impact on patients with these serious diseases." Barclays analyst Carter Gould inquired, "Can you provide more details on the trends you are observing with and your confidence in the reacceleration in the second half of the year, considering the decline in the US and flat performance outside the US? Additionally, could you provide further insights on the potential market share assumption for Opdualag in melanoma and what would be considered a reasonable market share?" Adam Lenkowski replied, "We are pleased with the growth of our cell therapy franchise, particularly with Abecma, which saw a year-on-year growth of approximately 50%. The decline in the second quarter was primarily due to pricing dynamics in Germany and planned manufacturing maintenance in June. However, we anticipate a significant increase in volume in the fourth quarter with the expected approval of Karma 3. We also anticipate increased competition in the US market with the use of other BCMA agents. Nonetheless, we remain confident in Abecma's outlook for the second half of 2023 and beyond, based on favorable perceptions from physicians regarding durable responses and high manufacturing success rates." Moving on to Opdualag, it is rapidly becoming the standard of care in the US, with strong sales growth and a share of approximately 25% in first-line metastatic melanoma. Our share is sourced from both PD-1 monotherapy and the Opdivo-Yervoy combination, with 2/3 coming from PD-1 monotherapy, split evenly between Opdivo and Keytruda. The recent update in NCCN guidelines has further strengthened our position, particularly in the BF mutant patient population. As a result, our total share in the overall metastatic melanoma market, considering Opdualag, Opdivo-Yervoy, and Opdivo monotherapy, now exceeds 55%. We are proud of our continued leadership in this area." Sumit Hirawat replied, "Our company has a robust program in place for the approved indication in metastatic melanoma. We have ongoing studies in adjuvant melanoma and colorectal cancer MSS, with readouts expected in the coming years. Additionally, we are eagerly awaiting data next year for non-small cell lung cancer and hepatocarcinoma in both first and second-line settings. This comprehensive program demonstrates our commitment to addressing the needs of patients across multiple indications." Wolfe Research analyst Tim Anderson inquired, "Can you please provide an update on the potential impact of the Part D redesign starting in 2025 on your company's earnings? Additionally, could you explain the factors driving the lower average net selling prices for Opdivo in Europe during Q2? Chris Borner replied, "The impact of the Part D redesign on IRA is product-specific, with both positive and negative factors depending on the specific product and patient population. It is important to analyze the details and understand how it will affect each product, considering the patients being treated and their concomitant medications." Now, I'll pass it over to Adam to address the Opdivo question. Adam Lenkowski replied, "Our international market for Opdivo continues to show strong growth, with a 10% increase year-over-year and quarter-to-quarter. This growth is driven by our core business in first-line lung and gastric cancers, as well as the unlocking of new indications. We are particularly pleased with the approval of Checkmate 816 in Europe. While there may be slight price decreases in some markets due to new indications, the volume of sales and reimbursement for Opdivo will offset any price decline." Giovanni Caforio replied, "That's correct. As we've previously discussed, the impact of the IRA dynamics won't be significant for our company until 2026. Therefore, the factors Chris described won't have a meaningful effect on our profit and loss statement or our outlook for 2024 and 2025. Citi analyst Emily Hutchinson inquired, "Can you provide more details on the 2% sales growth of Opdivo in the U.S.? Specifically, can you elaborate on customer buying patterns and any other factors that may have influenced this growth, such as competition?" Adam Lenkowski replied, "We are pleased with Opdivo's performance in the first half of the year, with overall growth of 11% year-to-date. Our growth is driven by same-core tumors, such as first-line lung and gastric indications. In first-line lung, our market share is approximately 15%, and in gastric indications, our market share is approximately 50% across early adjuvant indications. Although there was some impact from unfavorable customer buying patterns in the second quarter, we expect demand to normalize and continue to grow based on the strength across multiple tumors. We are leading all competitors in every tumor in the U.S., except for first-line lung, where we are making good progress. We have several significant upcoming milestones, including the Stage 2 melanoma indication with a PDUFA date in October of this year. Additionally, we have exciting developments in first-line cis-eligible bladder with CheckMate 901, which we expect to be a catalyst next year, along with pending readouts in CheckMate 77P, CheckMate 73 liters, and others. Based on these factors, we are confident in Opdivo's ability to continue growing in 2023. TD Cowen analyst Steve Scala inquired, "What was the error in assuming the weakness in Revlimid was temporary, considering the guidance was reiterated at the end of April? Why is the expected decline on an annual basis expected to be less than before, despite the expected return to normal levels for the free drug program? Can government support be a reliable offset? Is the current cut unrelated to generic competitors? Additionally, have you observed weakness in the US GI market, and if so, what do you attribute it to?" Giovanni Caforio replied, "The softness in Revlimid revenue that we experienced at the end of Q1 was influenced by several factors. Firstly, the increase in generic volumes that entered the market in March had a significant impact on revenue variability. Additionally, the number of patients receiving free drug from the BMS Patient Assistance Foundation also increased during Q1 and continued to rise throughout Q2. This had a further impact on Revlimid and Pomalyst revenue. It's important to note that once the BMS Patient Assistance Foundation provides free drug to a patient, we continue to provide it for the entirety of their treatment. We have thoroughly analyzed these trends and their impact on both the quarter and the full year. Looking ahead, we expect the step-down for Revlimid to be lower next year due to a return to normal levels of patients applying for free product from the BMS Patient Assistance Foundation and the Part D redesign dynamics. As a result, we anticipate a step-down of $1.5 billion in 2024 and approximately $2 billion in 2025. These factors, along with our unchanged generic erosion assumptions, contribute to our revised expectations for Revlimid revenue. Adam Lenkowski replied, "In the GI marketplace, we are experiencing robust growth for Zeposia, with a 28% quarter-over-quarter increase and a 50% growth compared to the same period last year. Our focus on the first-line use of Zeposia in UC has been well received by thought leaders, resulting in approximately 60% of our business being in this setting. We have also made significant progress in improving access, with 40% of lives having either 0 or 1 step at it. Moving forward, we anticipate continued growth in the GI market. Additionally, Zeposia is performing exceptionally well in the MS market, with our share reaching an all-time high. We expect this positive momentum to continue throughout the remainder of this year and into 2024. William Blair and Company analyst Matt Phipps inquired, "Are you still confident in the $4 billion new product growth guidance for this year? Can you explain the drivers behind the expected 50% growth in the second half compared to the first half, especially if cell therapies remain flat? Additionally, have you seen the Opdualag data in non-small cell in-house yet to officially add it as a key milestone and long-term opportunity?" Chris Borner replied, "We are confident in the progress of our portfolio and are on track to double revenue this year. We have a clear path to reaching $10 billion to $13 billion in revenue by 2025. Camzyos has been performing well, and we have had access wins with Sodiq too. Opdualag will continue to be important, and we have upcoming catalysts for Abecma. Additionally, Breyanzi has shown strong growth." Adam, is there anything else you would like to add? Adam Lenkowski replied, "In the first half of the year, we are on track to reach an annualized revenue of $3.5 billion. However, we have several catalysts that will drive growth in our new product portfolio in the second half. We expect to double our sales compared to last year. We are eagerly awaiting the PDUFA date for Commands, which will expand the use of Reblozyl as a first-line treatment. We are also pleased to have secured a large pharmacy benefit manager (PBM) contract for Sodiq, which will transition patients to our commercial product over the next few months. Additionally, we anticipate a steady flow of patients for Camzyos, who will go through our hub and then transition to commercial product later in the year. It typically takes around 8 to 10 weeks for patients to move from our hub to commercial product. Furthermore, we are increasing supply for Abecma in preparation for our Karma 3 launch and ramping up production for Breyanzi in the latter part of the year. With these initiatives, we are confident in our ability to double our sales of new products this year. Sumit Hirawat replied, the Opdivo study for non-small cell lung cancer is currently ongoing and enrolling participants. We have not yet reviewed the data, but our decision to proceed to phase 3 will be based on a comprehensive analysis of the overall response rate and progression-free survival. We anticipate reviewing the data in early 2024. Credit Suisse analyst Trung Nguyen inquired, can you discuss the reasons behind the decline in Eliquis total sales this quarter, particularly the dynamics of gross to net in the US and faster erosion in the EU? How should we anticipate the impact on price demand for the remainder of the year and beyond? Adam Lenkowski replied, we are pleased with the performance of Eliquis in the US, where 75% of its business remains. Our NBRX share is over 70% and still growing, while our TRX share continues to show strong and linear growth. Additionally, the OAC market is also accelerating since the beginning of the year. However, we have experienced unfavorable gross-to-net adjustments due to an increase in Medicare and PHS patients, resulting in a lag in claims processing. On the international front, we are seeing demand increases, but this is offset by price erosion in certain European markets, as well as the impact of generic penetration in Canada and the UK overall. We expect Eliquis to continue its strong growth trajectory. SVB Leerink Partners analyst David Reisinger inquired, could you please provide more information on the expected volume of Revlimid generics in the next 12 to 18 months? David Elkins replied, our volumes exceeded expectations in March of this year, and we anticipate 2 planned step-downs in March of 24 and February of the following year. In terms of Revlimid's forecast, we have adjusted our guidance from 6.5 to 5.5 this year, with a step-down of $1.5 billion next year and $2 billion in 2025. This adjustment aligns us with previous consensus estimates. Wells Fargo Securities analyst Mohit Bansal inquired, regarding the inline portfolio, how confident are you in the growth trends and outlook you provided at the beginning of the year, especially considering the $300 million down revision for Pomalyst? With current growth rates at 2% including FX and 3% excluding FX, do you still have concerns about meeting the growth outlook? Giovanni Caforio replied, we have revised our expectations for Pomalyst and Revlimid. We anticipate around $300 million in sales for Pomalyst this year, which is approximately 20% of the $330 million we saw for Revlimid in the first quarter. Overall, we remain confident in the performance of our inline business and are reaffirming our guidance for 2025, both for our existing portfolio and new products. UBS analyst Yihan Li inquired, with the upcoming R&D Day on September 14th, could you provide a preview of what we can expect? Will there be any new data shared during this event, specifically regarding the CAR-T program? Additionally, could you provide any guidance on the timing of the data readout for the Phase 1 trial of CAR-T in SLE, which has a primary completion date in 2028? Chris Borner replied, we are thrilled to have the opportunity to discuss our R&D efforts in more depth during our upcoming event on September 14th. Our focus will be on sharing our R&D strategy, providing updates on our pipeline, and highlighting the programs and platforms that we are particularly excited about. This is an exciting time for our company as we enter a period with numerous catalysts. We look forward to diving into the details and discussing these catalysts with you. Sumit, over to you for the CAR-T question. Sumit Hirawat replied, thank you for your question. Our next-gen CAR-T CD19 therapy is currently in the Phase 1 study, which includes dose escalation and expansion. We anticipate adding additional indications later this year, with potential updates in September. In the meantime, we will be sharing earlier data readouts and progress updates as we continue the study. Raymond James analyst Dane Leone inquired, as you convert patients from free drug to commercial pay in SODIC-2, it appears that the pay for drug product is currently below 25% of total scripts. Will the effort to convert these patients to commercial pay impact your ability to gain further market share? Additionally, does your ASR agreement factor into your EPS guidance, or is it separate? David Elkins replied, yes, our guidance does include the anticipated $4 billion ASR in the third quarter. It's important to note that approximately 80% of the shares will be retired upon execution, with the remaining 20% being retired over the contract period. Adam Lenkowski replied, our objective is to surpass Otezla and continue to grow our market share, which is currently nearing 40%. We have seen month-over-month increases and expect this trend to continue towards the end of the year. We have already doubled the volume of TRX equivalents from Q2 to Q1, and we anticipate further acceleration. It will take some time to transition patients from the bridge to the commercial drug, around 2 to 3 months, but we expect this ramp-up to happen in the back end of the year. Additionally, starting in January of next year, we will unlock other plans that will further increase the number of patients moving into commercial supply. Overall, we are confident in the continued growth prospects for Sodexo in the back end of this year and into 2024. Cantor Fitzgerald analyst Olivia Breyer inquired, "Can you provide an update on Abecma's manufacturing capacity going forward? Should we expect future shutdowns to impact revenue? How do you plan to minimize revenue disruption from these shutdowns? Additionally, what is the bar for success in the Phase 2 trial of LAG-3 in lung? When do you anticipate moving into registrational studies?" Adam Lenkowski replied, "We are making progress in increasing our capacity for our cell therapy franchise, specifically Abecma and Breyanzi. The manufacturing shutdown only affects Abecma and is a routine maintenance process that will last for approximately 1 month. This shutdown is planned and accounted for in our capacity plans. The ramp for Abecma is tied to our overall supply plans, with KarMMa-3 being an important factor in that ramp. We have achieved over 90% manufacturing success rates and have had multiple ramps since the launch. The routine maintenance process is crucial for maintaining our strong success rate and preparing for increased capacity ahead of the KarMMa-3 launch. While there may be some impact in Q3, we expect Abecma sales to accelerate in Q4 and throughout 2024. Sumit Hirawat replied, "In regards to the question about LAG-3 non-small cell lung cancer, our Phase 2 study is currently evaluating the combination of Opdivo with chemotherapy, comparing it to chemotherapy alone. However, for our Phase 3 trial, we plan to compare the combination of Opdivo with chemotherapy to nemolizumab plus chemotherapy. This is an important consideration as we analyze the data and outcomes, ensuring that we achieve the desired level of effectiveness in Phase 3. The timing of the study will depend on when the data is available, and we are fully prepared to launch the Phase 3 program study dashboard promptly." Giovanni Caforio replied, "Thank you for your question. We are optimistic about the future of our company based on the performance of our inline products, the success of our launch portfolio, and the strength of our pipeline. We appreciate your participation and our team is available to address any further inquiries. Have a great day."